Podcast.
All right, ladies and gentlemen, welcome to today's episode, Life's Hidden Curriculum. This is a big episode here, so I want you to put on your thinking caps. Listen up, you may want to take notes. You may want to replay this a couple times because today I'm going to get into finance. Talked about this a lot on a couple different occasions, but I want to kind of really get into it today. A lot of information, and I want to make sure you guys are well equipped to make these decisions moving forward in your life. I'm going to be talking about finance today, mortgages, leasing, refinancing, consolidation, reverse mortgages, student loans, all that kind of good stuff. So if that's what you're into, buckle in because we're here. All right, so loans are just tools. Like a power drill, you can build something great or you can fuck up and put a hole in your foot. So you want to be careful and be sure you know what you're doing if you want to get involved with these loans. So here's a breakdown of the borrowing game. First thing you got to know, credit. That is a basic thing that we've talked about before on this podcast. You want to make sure that you have a pretty decent credit score. And that basically just tells the bank your ability to pay. Now, do I agree with credit and how it's built? No, I think it's bullshit. I think it's a whole bunch of nonsense, but that is a game that is played. And so you do have to at least have some sort of working knowledge and understanding of how that whole system works. Because if you didn't need credit and you just paid everything cash, you wouldn't have to take any money out to begin with, right? You just pay cash for whatever. But there are some things where it's difficult to pay cash for up front. And sometimes places don't even take cash up front. You know, if you want to buy a house, you know, for example, right? Not everybody's going to feel comfortable with you, you know, taking $300,000 and just being like, here, boom, cash. Not everybody wants to do that. It's a weird thing. So anyway, so how it functions, when you apply for a loan, the bank looks at your credit score. If it's high, you got like a 750 plus, they'll give you like a really good interest rate. If it's low, they'll charge you higher because they feel like, you know, you're risky. So your credit score isn't just a random number. It's a mix of your payment history, how much available credit that you're currently using, and how long you've had accounts open that have credit. So just something to keep in mind. Never miss a payment. Even a single payment where you've missed for like 30 days or more can fuck up your credit for a long time. So don't get involved in that nonsense. All right, so let's get into it. Some common financing options. First, we're going to talk about mortgages. And that is if you're like trying to buy a home. This is the largest loan specifically for real estate, and usually you pay it back in either 15 or 30 years. The house itself acts as your collateral, which means if you don't pay, then the bank basically takes your house. And what you're doing is you're saying, okay, bank, I need you to buy my house. And then what I'm going to do is I'm going to pay you in installments towards ownership of the home. So if you take out a mortgage with Wells Fargo or PNC or Bank of America or whomever, right? Basically, they're buying the home on your behalf, and then you make payments towards owning your home. And once you've made all of the necessary payments, then you actually get your deed to your home and you technically own your home, which means you no longer are paying anybody for your home. You have it outright, and that's one less payment you have to worry about. So before the 90s, mortgages were fucking terrifying. You usually had to put down 50% of the value of the home, and the loan only lasted for like 5 to 10 years or your mortgage. And at the end, you had to pay the entire remaining balance in one big ass payment. Most people couldn't, so they just rented. So think about it like this. Back then, you basically went to a bank and you were like, yo, trying to buy this house. It's like, all right, house is $50,000. I know that's ridiculous these days, but just bear with me. You had to put down $25,000. Right? And then you would make payments for the next 5 to 10 years. And then whatever else you owed at the end of that, you had to pay that off. And then you owned your home, right? Now, in some respects, people probably will time to do that now, honestly. But when houses are costing, you know, $400,000, ain't nobody really trying to do that shit. It is what it is. All right. So, but after the Great Depression, the U.S. government created the Federal Housing Administration, or FHA, and they insured loans so banks felt safer lending to everyday regular people like you and me. And this is what created the 30-year fixed rate mortgage, which allowed people to pay a small amount every month for decades. So instead of having to pay a large portion up front and then sometimes a large portion on the back end with like some payments in the middle, now you spread out all those payments over like a 30-year time frame. As a result of being able to create this new mortgage loan, people were able to market the American dream. And really, America started marketing the American dream of you too can own a home and have home ownership. After World War II, the government issued the GI Bill to veterans to get them into homes. And if you recall our previous episode, I talked about the GI Bill. Suburban developments like Levittown in PA were built at lightning speed. And you had a lot of these subdivisions that sprang up and that helped to contribute to what is also called as white flight, which is the opposite of gentrification, where you had all these people now, they were building up all these subdevelopments and developments out in the suburbs, building out the suburbs, and everybody was using their hard-earned money that they saved up or their jobs that they had in the city to go buy these homes and these houses on mortgages out in the burbs. So the pitch was owning a home means you were a stakeholder in democracy. It meant that you had a stake in your community and it created a massive middle class. The reality is, though, you also had minority groups that were excluded from this, redlining, because again, we still are just getting into the civil rights era. And so there were still people that were like, nah, I'm not trying to lend money to Black people. I'm not trying to lend money to Hispanics, or I'm not trying to lend money to certain demographics or ethnicities because I just don't believe that they should be there. In addition, there are people that lived in those communities that said, I don't want these kind of people in my community. Right. So, they put pressure on banks and lending institutions to say like, yo, like, don't lend money to these people. Like, I'm not trying to have these people live here. I don't care how much they make. I don't care where they work. I don't care none of that stuff. Like, I'm trying to live in a neighborhood with people that look like me. I know America just really hasn't changed that much. If you really think about it. Anyway, so that helped to actually create the massive wealth gap that we see today. Still exists. All right. So I had a question. Do mortgages drive up house prices? Yes, they fucking do. Think about it like this. If nobody could get a loan, right, a house would only cost what someone would be willing to pay for it in cash. So maybe let's say $50,000. But because a banker says, well, I'll give you $400,000 and you can pay me back over 30 years, now people can put in a higher bid. And we saw that with the housing crisis just recently, a couple of years ago, where people were just, a lot of these houses were really only had a property value of like $250,000, maybe $200,000, and they were going for twice that value because people were really desperately trying to get out of the city or move or relocate for whatever reason. Maybe there was a change in job, a loss in job, or, a life event that was happening. And so if they had the capacity, if they had the means to be able to move, you had a lot of people who were looking for opportunities to maybe retire, older individuals who, again, own their home, who were being told, well, hey, like, you bought your home for, let's say $80,000 and it's paid off. But now, what if I told you somebody's willing to pay $250,000 for that? You look at that like, yo, that's love. Like, it's only worth $80,000, but like somebody's gonna pay me $250, say less. Then what if somebody else came in and said, I'll pay you $400, right? And so now what that also does is that creates a trickle down effect. So if in one neighborhood, a house over $400,000 and it's just like the house next door to it, then that means the value of that home too, right next to it, is also comparably around $400,000. And that raises the values of those entire neighborhoods, especially if more people are trying to sell or like move out of that neighborhood. It just drives up the cost, which again, that doesn't necessarily mean that the value of the home is that much. It's just how much somebody's willing to pay. And that's how some people define value, is how much someone's willing to pay for it. Doesn't actually mean intrinsically it's worth that much, but somebody's willing to pay for it that much. Just like the clothes you got on, probably. Won't get into it. I'm going to stay right here in this lane. We're talking about mortgages. Anyway, the cycle. Lower interest rates means people can borrow more people bid, which means house prices go up. All right, the mechanics. How does a mortgage actually work? So when you buy a house for, say, $400,000, you just don't get a loan. You deal with these different parts. You have a down payment. So this is your skin in the game. Usually it's 3 to 20% of the price. If you put down less than 20, the bank makes you pay a PMI, which is a private mortgage insurance. It's an extra monthly fee that protects them if you fuck up. Closing costs. These are the hidden fees that you pay On the day that you get the keys, expect to pay anywhere from 2 to 5% of the home price in taxes, lawyer fees, and appraisal costs. It's a lot of cash up front. Your amortization schedule. This is the math the bank uses to make sure they get paid first. In a 30-year loan, your early payments are almost all interest. You don't start making a real dent into the actual principal, which is the actual loan amount for the home, until about year 15. So they put that on a sliding scale. So basically, let's say you end up leaving, right? The house for whatever reason. Let's say you can't afford it. Let's say you found a better home, whatever the case may be, right? And you basically are paying upfront all the money that you owe to the bank just to service and finance your mortgage. You're not even paying for the value of the house yet. You're paying all the shit that the bank is asking for, which is the interest and all the other processing and servicing fees and all that kind of other shit. It's bullshit. But again, this is the game that is played. So putting you up on game here. Escrow. So this is a side bucket where the bank holds extra money you pay each month to cover your property taxes and homeowners insurance. They pay those bills for you to make sure the house, which again is their collateral, stays safe and stays legal. All right. So we talked about mortgages. Now there's this fairly recent phenomenon called the reverse mortgage. Put y'all up on this. This is not really even something that can really be talked about unless you actually own the home, right? If you're not making payments on this house anymore. So this is mostly for like retirees or older people. But I want to make sure you know what a reverse mortgage is, so nobody talks you into no stupid shit. So it's grown in popularity because of the baby boomers who own trillions of dollars in home equity, but they may not have enough cash to pay for like everyday expenses or like rising healthcare costs, et cetera, et cetera. And they might not have enough money for retirement because, again, you know what the economy in the world is looking like these days. Healthcare costs, it's an easy way to pay for medical care without moving into a nursing home, which a lot of older people don't want to do. For people who don't have pensions, because again, pensions got phased out and got replaced by these 401k, 403b type of retirement plans that are all based on the stock market, which means that their value can fluctuate and you can actually lose money that you were expecting to have when you retired so that you could like have money to retire on. Instead, they said, well, let's put it in this fucking bullshit ass lottery system, essentially, and we'll see what happens. Maybe you can make more, maybe you can make less. I don't know. Whereas the pensions, it was stable, it was fixed. You knew what you were getting because the pension was being paid into by the company that you worked for. But the company that you work for got talked out of doing that because pensions are expensive to the company. Imagine you got 100 employees and you're paying, even if you're paying like $100 per employee, that's $100 that you're paying every month or every paycheck or whatever towards their retirement. So if they're there for, how many ever years, you're paying all that money into that. So a lot of organizations were talked out of doing that and instead said, well, here, let's just go with my company. And instead of you putting all that money in, you just put in like a small percentage. They put in a small percentage and then we'll put that money in the stock market for you and we'll see what happens. A lot of people lost money and corporations made money off of it. Again, not going to get into it. Just going to get into it. Anyway, so that was another reason why reverse mortgages became popular with older people because they didn't have the stable income and rising healthcare costs. And also they wanted to quote unquote live it up, right? These are supposed to be my best years. I've worked so hard and now I get to do the things I finally wanted to do, whether that's vacation, whether that's travel, whether that's do something I'm passionate about, whatever. So are reverse mortgages good or are they bad? Well, here's some pros and cons. Pros is that there's no monthly mortgage payment. But the con is the loan balance grows every month as interest is added. So basically, what is a reverse mortgage? Let me start with that. A reverse mortgage is actually when you sell your home to a bank little by little. So instead of with a traditional mortgage, a bank buys your home and then you pay the bank towards owning your home. A reverse mortgage is actually the opposite. You own your home and you're selling your home to this bank little by little. So you actually get paid each month by the bank for ownership of your home. So what happens in the end? The bank owns your home. You don't have the home anymore. Why is this important? Well, one of the things that fucking sucks is that home ownership is one of those things you get to pass down to your next generation. Now, if you don't plan on having any kids or anything like that, then maybe it's not that big of a deal. But if you do, you kind of cut off an important lifeline for that next generation to start, to start from. They're effectively going to have to start from zero, whereas they could have started at least with a place to stay that they don't have to pay for. They have to pay for, insurance and property taxes and, utilities, that kind of stuff. But, the payment of rent or for mortgage, they don't have to pay. They have a roof over their head already, which is a big, big step up for a lot of people. But if you go into this reverse mortgage and you sell your home slowly over, a time period, and now you no longer own it, now you're at the mercy of a bank. And what's even crazier is if you do this reverse mortgage option, you sell your home to a bank, the bank now owns it, they can kick you the fuck out. Bye-bye. You're going to turn your house into a Starbucks. We're actually going to destroy your home and we're going to level it, and we're going to use the land in and of itself has higher value than the land with the house on it. And so we're going to turn that into a Starbucks. I mean, these things actually happen, which is crazy. So one of the pros is you get to stay in your home, but then the closing costs are high compared to regular loans. The money is tax free, which is also a pro, but then your kids get less or get nothing when you pass away, or, once the term of the reverse mortgage is up. Again, you don't own the home anymore, and now you effectively could be homeless because, again, the bank is not obligated to allow you to stay in the home once they own it, right? Because, again, there's no relationship there anymore. They paid it off. It's theirs now. They can do it whatever they want to do with it. So this is considered like a loan of last resort. It's great for a senior who wants to age in place and has no heirs, but it can be predatory if a bank pushes it on somebody who doesn't understand that they are essentially selling their house back to the bank piece by piece. Something to keep in mind. So let's talk about some highs and lows about mortgages. So the post-World War II boom, mortgages created the largest middle class in human history. I said that before, but the negative, you had the 2008 financial crisis where banks gave mortgages to people who couldn't afford them on these subprime loans, and then bundled those loans into investments and sold them to other investors who then realized these were just terrible investments. When people stopped paying because they couldn't afford them in the first place, then the global economy basically broke overnight. And you had all these people who were basically scamming the American people, some of which are your parents, some of which are your grandparents, basically scammed them into situations, and then they just bounced and they left. It was like, well, I made my money and I'm on to the next thing. It happens all the time, unfortunately. So, when we're talking about a mortgage, here's some pros. You get to build equity, which is basically ownership value. You get potential tax breaks and you have a place to live. So by getting a mortgage and starting that process of home ownership and paying a bank to basically get ownership over a home, over a residence, over real estate, little by little, and eventually at the end, once you've paid it off completely, you now have this space, you have this place, you have this area of land, you have something that is yours, that is identified as yours, and you've made this investment into it. And what you decide to do with it is completely up to you. Now, one of the cons is that that's going to take you about 30 years to do. Now, you can pay things off early. You can do a lot of different things, but you have to read the fine print because sometimes you'll actually get penalized if you pay your loan off earlier than expected. Because again, the bank is anticipating you being able to make payments toward their interest for X number of years. So if you pay off your balance way too early, well, let me put it like this. Every payment towards your balance reduces your interest because their interest is calculated off your balance. So the more balance you have to pay, the more principal you have to pay, then the more money that banks get to make off the interest. When you start paying off that principal, that balance gets affected. So banks inherently don't want you to pay off your principal early. But if you make payments towards your principal, which you can do anytime, you can make additional payments. Sometimes they'll have in the fine print that you can't pay it off early. the earliest you can pay it off is like 25 years or something like that. Like they want to lock in as much of that interest that they can. So make sure you read the fine print. Any early termination or anything like that, prepayments, that kind of stuff. Just make sure you are aware when you are looking through your documentation about that. Now, one of the cons also is that you're responsible for any and all repairs. So home ownership comes with that. So, a tree falls on your roof, you got to pay for all that kind of stuff. So, you don't have a landlord, you don't have anything. Homeowners insurance covers certain things. You might get a home warranty. Again, that can cover certain things, but it doesn't cover everything. And again, those things are additional payments. So, homeowners insurance is in the event that you get sued because something happens on your property. Let's say somebody trips on the sidewalk and they want to sue. Well, your homeowner's insurance will kind of take care of some of that. But at the same time, you have to maintain your end of the bargain as well. So you can't just have a shitty ass sidewalk and then somebody gets hurt, then that's going to drive up the cost to insure your property. But in the event that you've been doing your job and something happens, you're not being sued directly. They're suing your insurance. Your insurance has a whole conversation on your behalf. They work it out in the courts, and then they, if necessary, will pay on your behalf, and you don't necessarily come out of pocket. Now, your premium, what you pay for your insurance, might increase a little bit, but again, it's instead of you paying $1 million, you may only have to pay like an extra $10-15 a month for X number of months or whatever. Again, read the fine print on that. All right, let's go to refinancing. This is a big one I hear a lot. Refinancing, and it's like the do-over. So refinancing is when you take out a new loan to pay off an old one, usually to help you get a lower interest rate or a lower monthly payment. Now, here's one of the pros is that you can save thousands in interest by doing this, and it can shorten the length of your debt. However, there are closing costs and there are fees to do it. And if you're uncareful, you might end up paying more interest for longer. So you have to really weigh your certain situation and the pros and cons with relation to if refinancing is a viable option for you. So basically, refinancing, like I said, is when you take out a completely new loan to pay off an existing loan. You aren't skipping payments. You're replacing one contract with another that has better terms, usually lower interest rate, or, like I said, a lower monthly payment. But now you have to keep in mind that you're starting a new loan. So I'm going to get to that in a second. The history. Refinancing exploded in popularity because interest rates in the U.S. aren't static. They move with the stock market. So in the 80s, mortgage rates were around 18%. So imagine paying $18 in interest for every $100 you borrowed. Crazy, right? But in the 2020s, rates dropped to around 2 to 3%. So a lot of people started cashing in and be like, yo, hold on now. Let me refinance because I like these rates that I'm paying right now. These rates that I'm looking at 2 or 3% versus 18. Yo, sign me up for that. Again, you're starting a new loan based off of a new interest rate. So I'd be saving more money, but it all depends on how much you're having to pay for. For some people, it makes sense. For others, it makes no sense. So millions of people who bought houses in the 90s or 2000s refinanced to capture these lower rates, saving hundreds of dollars a month. It turned from a rare financial move into a massive industry, which again, people made money off of refinancing because again, it's a new loan. Now, it's free. These are some myths and some, conceptions about what refinancing is. So I just want to break it down for you. It's free. No, it's not free at all. Refinancing a home costs money. You have to pay for a new appraisal, title insurance, and bank fees, which are your closing costs. And it usually costs 2 to 5% of the loan amount. If you don't stay in the house long enough to break even, you actually lose money. You may think, oh, well, it lowers my total debt. Also false. It lowers your payment, but it often extends the time that you are in debt. So if you are 10 years into a 30-year mortgage and you refinance into a new 30-year mortgage, you just signed up to pay interest for 40 years because you already paid the 10. Now you started a new 30. So now you're in 40. I mean, yeah. And people believe that I can just do it anytime. Well, sort of, right? You need good credit and use equity in the value of the asset, which is the home. If your car house is worth less than what you owe, then banks won't let you refinance. Let's say your house is valued at $100,000 and you've already paid off like $60,000 of it, right? And you only got $40,000 less. You want to like refinance and get that lower rate. They're probably gonna be like, nah, bro, we ain't gonna do that, bro. Because you know what I'm saying, you kind of taking money away from us, and we trying to, you know what I mean, like we trying to extend this joint. Like you just, it makes sense what you're trying to do, but what you're trying to do actually, we lose money, so we not really trying to do that. Crazy, right? I know. I know. So where people often get tripped up is that you think it's a cash out opportunity. This is when you refinance for more than you owe and you take the difference in cash. People use this to go on vacation or buy jet skis or live lavish. But here's the danger. You're actually turning your home equity into spending money, which leaves you vulnerable if the housing market crashes. So if you take money out against how much you've actually invested, again, that's your ownership of the home. The other side of that, the other people who own the home are the bank. So if you cash out your value in it, of your home, then that means now the bank owns even more of it because they own the balance and you have no equity because you just cashed it out to do whatever you decide to do with it. So again, until you've built up more equity, and unless you've made more payments into it by refinancing, you have to be very careful of like where that balance is, because you don't want to be in a situation where you have no equity in the home, the bank has all the equity, then they might say, you know what, we're just going to redo this all together and we're going to kick you out because we just want to do something different now. And you have no equity because you already cashed it out and you went to Bora Bora or whatever and you was balling on the budget. It's not worth it. Resetting the clock. Again, I mentioned this before. If you refinance, you're going back to year one on your loan, which means you are going back to pay mostly interest once again and very little principal. And there's a break-even point. So if it costs you $5,000 to refinance and it saves you $100 a month, it'll take you 50 months, so a little over 4 years, just to get your money back. If you move before then, you lose out on that $5,000, right? It just doesn't make any sense. So if you're going to refinance, make sure, one, you absolutely need to. Two, make sure the numbers work in your favor. It's going to actually be it's going to be a value add and not just like mostly the same. And three, make sure you have the longevity to actually be able to stay in that circumstance, in that situation. Because if not, refinancing actually is going to be more detrimental to you than anything else. Now let's talk about consolidation. This is a specific type of financing often marketed to people with high credit card debt or just high debt in general. You know, you talk about consolidating loans or consolidating your debt. Debt consolidation is when you take one big loan at a lower interest rate to pay off 5 to 10 smaller high interest rate debts, like credit cards, medical bills, that kind of stuff. So let's say you owe $20,000 across 4 credit cards at 25% interest. You might take a consolidation loan that's 10% interest. You pay off the cards and now you only have one monthly payment to the new lender. But here's where people get fucked up, because in their minds, like, okay, I'm cool. And so what they do is they start maxing out the credit cards again. And you don't want to do that, because when you do that, you started this whole process all over again. You've actually undone the progress that you made, because by maxing out credit all over again, you went from a situation where you've gotten your credit under control. And now you have this loan payment here that you're paying off, and now you're adding additional payments onto other areas of credit. So again, you want to use your consolidation option as like I'm going to get this done. I'm going to pay this off before I do anything else. I'm not going to do any new credit, no new nothing. I'm going to consolidate, get all these things paid off, and then start fresh. If you try to consolidate and use credit, keep in mind what you're doing is basically putting dirt back in the hole that you're digging yourself out of. It just doesn't make a lot of sense. So, words of wisdom. Okay, so alternatives to refinancing. Here's what you can do. If you want the benefits of refinancing without the high fees, you have a couple options. You can do something called loan recasting, which is basically you pay a large lump sum towards your principal and the bank recalculates your monthly payment based on the new lower balance. Now, again, I told you before, banks don't often like to do this, so they're not going to tell you about this up front. And sometimes they'll even have little disclaimers or little terms in their conditions that says you can't do this or you can only do so much of this, et cetera, et cetera. Now, this is a situation best for when people just inherited money or got a big bonus, right? Again, talk to your bank and see what those terms and conditions are related to trying to do some loan recasting. You can also do a loan modification. Let's say there's been a change, which is a change to the original terms of the loan because the borrower is in a financial hardship, like lost a job, family member got sick, that kind of stuff. You can reach out to your lender and say, I'd like to do a loan modification based on the new circumstances. And this could be a situation where, a scenario where you might be struggling to keep your home, right? Because you can't make payments and you want to get that modified so we can figure out some sort of solution. And another one is extra principal payments, which I talked about previously too. And you could simply pay an extra amount a month towards the principal, so your actual debt of what you actually owe. And this helps shave off years of your loan without any fees or paperwork. I'm sorry. Let's talk about comparing refinancing and consolidation. So the primary goal of refinancing is to get a lower interest rate and better terms, whereas the primary goal for consolidation is to simplify multiple payments into one. A typical asset for refinancing, things like mortgages, car loans, student loans, whereas consolidation is typically you're consolidating credit card debt and personal loans. Now, one of the key risks of refinancing is you're extending the debt for too many years. And one of the risks for consolidation is running up your old debts again. So things to consider and keep in mind. Now, let's get into leasing, which is effectively long-term renting. This is common with cars, but also if you think about it, apartments as well. If you're renting an apartment, you have a lease with your landlord. You aren't buying the car, you're actually paying for the use of it for a set period of time. At the end, you have to give it back. Or if you are on a lease to own type situation, you might be able to continue to pay for it until you actually own the vehicle yourself. And they have different arrangements for that. So something to, again, always read the fine print if you're going to go into these kind of agreements. But in a sense, leasing is you basically don't have anything when you're done. You have made these payments. Think of an apartment, right? You could live in an apartment for, 50 years. And there are people who have effectively paid rent long enough that they've actually paid off the value of the place that they're in. And yet, because they're leasing, they don't actually have ownership. So the landlord can still come in and say, you're out of here. Like, wait a second, I've paid rent for like 20 years. I've paid well over, $300,000 for this little 2-bedroom. And I know the value of it is only, $80,000. Yeah, well, it's not yours, it's mine. So I've made all this money off of you, over the last how many ever years that you've been paying over. Sucks for you. That's the game that's being played. So anyway, pros to leasing is that you have a lower monthly payment than a standard car loan or, an apartment, a mortgage, and you always have a new car under warranty. And again, same with apartments. You can go from one apartment to another apartment. You have that flexibility to kind of move around as you see fit. Let's say there's a different job opportunity or you want to move in, you want to add a roommate, you want to live in a different city, you want to travel, that kind of stuff. But one of the cons is, once again, at the end, you own nothing. It's not yours. And with a car, you have strict mileage limits, and it's usually the most expensive way to drive over the long term. A lot of that, again, was just for a car. So where did leasing come from? Well, it's not a new thing. It's actually super old. In 2000 BC, Sumerians used to lease land and tools to farmers. It was a way for someone with no equipment to start a business. And in modern days, for a long time, only businesses leased equipment like computers or airplanes because they could write off the cost on their taxes. And in the 80s, car manufacturers realized that cars were getting too expensive for the average person to buy outright. So to keep people, quote unquote, buying new cars every few years, they marketed individual consumer leasing. This made that $50,000 BMW look affordable by only charging for the use of it rather than the whole car. So again, you might enter into a lease agreement for this BMW that's $50K for 2 or 3 years, you're not paying for the entire car. And again, after those 2 or 3 years, as long as you stick with the criteria and the limitations that were in the lease, then you just gave it back. Crazy, right? But then when you give it back, you don't have a car, right? So you got to enter a new lease agreement, for a different car or whatever. Kind of like, well, I won't get into that. I was gonna say cell phones, but not everybody. Some people do though, unfortunately. Some people are leasing their cell phones. And if you think about it, we kind of are leasing music these days too, because we don't actually own it. If you're on Spotify, Apple, streaming services, you're kind of leasing. You don't own the music. You can't physically, tangibly play it whenever you want to. You have to log into this service to actually get access to it. And so if they revoke access for whatever reason, you can no longer play it. You don't tangibly own it. You can't just look at it and say, oh, here is this music, this artist, this album. You don't have that. It's a conversation that we're having in society right now. It's a very interesting conversation. So when does leasing actually make sense? Well, it's a lifestyle choice. It's not usually a wealth building choice, but it might make sense if you own a business. So in many cases, you can deduct the entire lease payment from your business taxes. This is why you see some people driving around in really expensive cars and they're business owners, because the cost of that lease they might deduct as a business expense. And you might value newness or novelty over equity. If you just have to have the latest tech and safety features and every 3 years and you don't want to deal with the repairs, leasing is the convenience fee that you pay for that. And if you don't really, let's say we're looking at a car, you don't really have a lot of places to go, low mileage lifestyle. If you work from home and only drive 5,000 miles a year and you aren't using up the car's quote unquote value, then leasing is probably a good, decent option for you. Now, let's get into the renting versus owning conversation. Some people might say renting is just throwing away money, but that's not entirely true. Some of the pros: mobility. You can move for a better job, or you can return a car without trying to sell it. You have predictability. Your costs are fixed. If the roof leaks or the transmission blows, that's an owner's problem. It's not your problem. And you preserve your capital. You keep your cash in your pocket instead of locking it up in a down payment. Now, here are the cons. Again, you have zero equity. So when the contract is over, you have nothing to show for all those payments that you made, whether it's on a car, piece of equipment, an apartment, et cetera, et cetera. Now, for the ownership, some of the pros: helps you build wealth. Eventually, when the payments stop, you own that asset, whether it's, again, the house or the real estate, the equipment, or the vehicle. You own it now. Once you've made all the payments, it's now yours. And you can sell it or live in it for free, minus whatever maintenance and repairs you got to do. So again, like if you own a home now, it's yours. You own it. You don't have to pay a mortgage. You don't have to pay rent anymore. And you can do whatever you want to do with it. No one can tell you what you can or can't do, type deal. Within reason. You lunatic. Again, you also have no mileage limits for a vehicle. You don't have any deposits for pets or first, last, all that kind of other stuff that comes with security deposits for apartments, that kind of deal. It's just yours. You do whatever you want to do with it. Now, one of the cons is you got to invest heavily in it. There's that lump sum risk of, again, if the HVAC dies or if a tree falls on it, you got to pay for all that. There's no one to contact other than like your repair person or your contractor, whatever, to fix it. So that's on you. Now you can go into payment plans with them as well, obviously, and a lot of service contractors do offer payment arrangement plans as well. And, they may work with a local bank and you may have to, do a line of credit, yada, yada with them. I won't even get into all that. But again, at the end of the day, like, you're not responsible for that. So instead of calling up your landlord, like, yo, my toilet's leaking, now you're calling the repair person and be like, yo, my toilet's leaking. And I was like, okay, we'll send somebody out there. It's going to cost you this much. And you're like, oh, who's paying for that? You are. Homeowner, you are. Gotta love that. Got to love that. Also, you can't just leave when you want to. One of the cons of homeownership. So once you start this 30-year journey, you're locked in for those 30 years. Now, there are some scenarios and situations that you can have a little bit of flexibility, but more or less, like, it's a long-term commitment. So if you don't plan on sticking around or staying in that area for the long term, you may want to really reconsider if homeownership is going to be the best bet for you. So let's look at let's put those pros and cons next to each other again. So upfront costs, if you're leasing, it's usually lower, usually just a small deposit if you're leasing, first, last, and security. However, if you're trying to own it, then you're talking about down payments and closing costs, which are going to be big. Remember, those are like a percentage, putting like close to 20% of the entire home's value as your down payment, plus fees, closing costs, all the other stuff that's included in addition to that. Your monthly costs are typically going to be lower if you're leasing because, again, it's just fixed. It's, rent is going to be $800 a month to due on the 1st or the 30th, whatever, blah, 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 blah. Whereas for home ownership, it's usually higher because you're paying for the cost of the whole asset. Now, there are certain situations, particularly here in Philadelphia, where you may really find yourself questioning, do I want to pay $1,450 for this 2-bedroom apartment when I could be paying $1,350 or $1,250 for a house that I get to own? Again, it goes back to how long do you plan on staying in this location? Do you have the money to put down towards the down payment and all the other costs and all that kind of stuff that goes into that? Because if you can do that, right, then it may make sense to just go ahead and try to get a house. If not, if you're in a position where you're likely going to move or relocate, or you don't have the savings to be able to put money down towards that, then it would probably make a lot more sense to just go ahead and rent. Now, again, I go back to the reverse mortgage conversation. Imagine you already have a place to live already established. Now, when you have the conversation of do I want to own or do I want to rent, man, the amount of money that you probably could save by not having to worry about where you're going to live, you could then put that money aside, build up a little bit of savings, and have enough money to have a down payment over the course of a few years to put towards your own home ownership. So now you may have inherited a home from your parents that have passed away, or nursing home, or whatever the situation may be, but they've gifted you a place to stay, and you may have worked through high school, worked a little bit in college, whatever, and now you're living, you have a place to stay, so you're living there, and the money that you're making, you can put some of that aside, and then once you have enough for a down payment, you could say, okay, well, I'm thinking of moving, or I'm thinking of doing X, Y, and Z. So I'm going to now take this money I've saved, use that as a down payment. I got a really good job. I can make the payments for the mortgage, and I plan on moving in with my girlfriend, and we're going to start a family, and we're going to get married. And so now I already have this one home that's in my name. I've gotten a mortgage for a new home. Let's say you got a house in Philly, but now you're moving out in Bucks County. I got a mortgage for this house out in Bucks County. We're moving in with my wife. And now what I can also do is this home that I got in Philly, maybe I can rent that out to somebody. But I got to be savvy enough to know how home ownership and building maintenance and property management goes. But if I can rent that out, the money that I get from that rent, which is revenue, can help pay for my current mortgage. So again, now the money I'm making from my job that I work at, I can, again, pocket that, put that in my pocket, or help pay off my current mortgage even faster. Because now you have two revenue streams. Again, this is how people get that leg up in between generations. It's why it's so important a lot of times to have home ownership that helps the next generation. Because if you don't have that, you're asking the next generation to start from scratch all over again. So if you came into a situation where your parents didn't own their home and they were renting, and now after X number of years, they get kicked out and they don't have anywhere to go and they got to start renting again. Now you come into a situation where now you're just now starting, you're going to have to start renting. And it's going to be the same thing. Like no one's ever going to have equity in any of the assets that they currently use until someone eventually breaks the cycle and then does own a home or does kind of start that process. And again, that's when the following generation gets to have that benefit, provided that y'all don't have a falling out. Okay, so we're going to go back to the script here. And we're talking about the comparison between ownership and leasing. We're talking about maintenance. So maintenance, when you lease, is usually covered by the landlord. They do all that kind of other shit. But if you are going to be a homeowner, that falls under you. That's your responsibility. In the end game, when you're done with your lease, you don't own anything, right? You've just been paying to use it. So therefore you get nothing. But if you are the homeowner, you eventually own the home and now it's yours. Do whatever the fuck you want to do with it. And the flexibility when you're leasing, very high. You don't like it anymore, you can leave. Understand the terms of your agreement or your lease agreement. If you're breaking a lease, if you're not, what you need to do, that kind of stuff. But if you are a homeowner, there is no leaving. Like, you're locked in for 30 years. Now, if you got the money to burn to be able to continue to pay that off and then go live somewhere else, then I ain't gonna tell you what to do with your life. But most people don't have that kind of flexibility. So once you're locked in, you're locked in. And let's talk about why ownership is usually better. Well, in the long run, ownership wins because of the finish line. If you lease cars your whole life, you will have a monthly payment until the day you die. If you buy a car and keep it for 10 years, even with repairs, you will have 5 more years of zero payments. So those skip payments are what allow people to actually save for retirement and or buy a house. Let's talk about the Vimes boots theory. It's often more expensive to be poor or short-term minded. A person can afford to buy a $100 pair of boots that last 10 years, spends less than the person who has to buy a $20 pair every year because they can't afford the $100 up front. So ownership is the $100 boots, right? Does that make sense? So basically, if I can afford to buy $100 pair of boots and they're going to last me 10 years, right? That's a better value trade in as opposed to the person who has to buy a $20 pair of boots every year. Because again, after 10 years, I've paid $200 for a $20 pair of boots every year for 10 years. Whereas the person who spent $100 for the next 10 years has only spent $100. So that is kind of one of the trade-offs and the benefits of ownership versus renting is that, yes, it's a big cost up front, but that value is there for a longer period of time. And again, you get the end value. So one major warning. So the lease end trap. When you return a lease or when you're done with your lease and you're wrapping it up, whether it be a car or an apartment, they're going to inspect that with a magnifying glass. And yes, that is absolutely true, whether it's a house or a car or apartment or car. Any tiny scratch on a rim is going to run you $400, something like that. If there's a stain on the carpet, that's going to eat away at your deposit, which is the money you're supposed to get back at the end. And then if you go over your whatever agreement, your miles, if you will, for the car, they're going to run you for that. So there are all these fees that are associated with returning the property to the condition in which you found it or which it was given to you, which is why it's also important that when you move in to any new apartment or you get a new car, you document. Look at all the pictures. You test all that kind of stuff to say this wasn't working when I moved in, or this car already had this scratch right here on the bumper when you first gave it to me. So then that way on the back end, you're not being charged for things that the actual owner is responsible for. All right. So trying to get through some of this stuff. I still got a few more pages. I'm going to try to stick to the script as much as possible because I do got a lot to do. So my apologies for being lengthy here. I'm already approaching the hour mark. Ooh, geez. All right. So student loans are unique because unlike a mortgage or car loans, there's no physical thing that the bank can take back if you don't pay. You are the collateral. So you are essentially selling a share of your future earnings to pay for your present education. So in 2026, the landscape shifted with I hate even calling it this, but the One Big Beautiful Bill Act signed by President Trump, which overhauled how these loans function. Now, that's one positive I think I can say is that it at least there's a little bit more clarity and clarification, but as I've come to realize, there's always some sort of catch. Somebody's still making money somehow. I won't get into it though. So how student loans function as of 2026. So there are two main flavors of student loans. And the difference between them is the difference between safety and being on a tightrope. So federal loans are your safety net. These are funded by the government. And as of the 2025-2026 school year, undergraduate rates are around 6.39%. So you have the subsidized and unsubsidized. If you're subsidized, if you have financial need, the government pays your interest while you're in school and it's frozen until you graduate. If it's unsubsidized, interest starts ticking the second the money hits your school account. Even while you're sitting in class, interest is accruing that you have to pay. Now, if you go private loans, which is your other option, you can go federal, you can go private. You go private loans, these are banks like SoFi or Sallie Mae. They function more like credit cards or a car loan, and it's risk-based. So your interest rate depends on your credit score. If you don't have any credit history, you'll likely need a cosigner, usually a parent, which then ties their financial circumstances to yours. So if you fuck up, it affects them. And vice versa. If they fuck up, it affects you. And you got fewer protections. So if you lose your job, private banks really don't give a shit. They want their money. Whereas the government, is likely to kind of give you a little bit of leniency because the government can cover the cost of it. So when is it a bad idea to try to get a student loan? Well, there's a mathematical quote unquote red line where a degree stops being an investment, starts becoming a burden. Here's the golden rule. Your total student debt should not exceed your expected first year salary. So here's the math. If you want to be a social worker and your job is going to roughly be about $45,000 and you take out $100,000 in loans, you are mathematically underwater, my friend. So here's the 10% rule. You should aim for your monthly loan payment to be no more than 10% of your gross annual income. If your expected payment is 30% of your paycheck, you won't be able to afford rent, let alone have any sort of life. Under the new law or the new rules, the Grad Plus loans, which let graduate students borrow unlimited amounts, those have been eliminated and replaced with strict caps. This was designed to prevent people from borrowing $200,000 for a degree that pays $60K. Okay? Here's some facts versus misconceptions. So here's the myth. Then here's the reality. Myth. I can just declare bankruptcy and wipe them out. No, extremely difficult. While it got slightly easier in 2024 and 2026 for federal loans, you still have to prove undue hardship. Basically, that you physically, mentally cannot work for the foreseeable future, which is very difficult because it's going to be hard for you to flex on Instagram and then claim that you're bankrupt. Just can't do it, right? So another myth, forgiveness is automatic after 10 years. Well, no. Programs like the Public Service Loan Forgiveness Program require that you work for a nonprofit or government agency and make 120 on-time payments while still having to file a bunch of crazy paperwork. Now, you can do it, but you're going to have to jump through a whole bunch of loops to be able to do it. But that also, again, requires that you have to work for a specific type of nonprofit or a government agency to be able to qualify for that. So like teachers, if you're in the military, that kind of stuff, those are some options that you could pursue. But again, you have to actually do the work and you still have to make payments for a set period of time. Then maybe after that, whatever you owe can be taken care of. Myth. My parents are responsible if I don't pay. Only if they co-signed or took out a Parent Plus loan. If the loan is in your name only, it's 100% on you, bro. And if you do that, and if you say, fuck it, I'm not going to pay it, it's going to destroy your credit, which means it's going to make it almost impossible for you to have a future, whether it's getting an apartment, getting a car, buying a house, sometimes even getting married or getting certain jobs because they do check your credit for certain jobs. Another myth, I should always borrow the max amount offered. I can tell you right now, absolutely not. Schools often award more than you need for tuition. If you use that extra money for spring break or a new laptop, you're paying 6 to 8% interest on that vacation for the next 20 years. So again, if you don't need it, don't get it. Because you may think in your mind, oh, I got extra cash, I can do whatever. You're paying interest on that for a set duration of time. So here's the 2026 repayment game. Under this new law, if you borrow today, you generally have only two options. There's a standard plan. You can pay a fixed amount for 10 to 25 years, and it's the fastest way to get debt free. Or you can get a repayment assistance plan. This is an income-driven plan where your payment is capped at 1 to 10% of your income. If you make very little, your payment could be as low as $10 a month, but here's the catch. Any remaining balance is forgiven after 30 years, but that forgiven amount might be taxed as income. So you may actually end up getting screwed on the back end because they'll say, well, instead of you having to pay all this amount, we'll take it out, but you're going to get taxed on it, which could be crazy if you got a crazy amount that's still out there. So why do banks and governments do this? Well, the government does it because they want an educated workforce, because educated people generally pay more in taxes over their lifetime. They service these loans or hire companies to do it to recoup their investment. How do banks do it? Well, this is the stickiest debt that's in existence. You can't sell your degree. You can't easily discharge it in bankruptcy. For a bank, a student loan is a reliable, decades-long stream of interest payments that is very hard for the borrower to escape. But let's talk about how banks make money. Why do they do this to begin with? Well, banks aren't charities. They aren't retail stores for money. And here's how they profit off of you, us, me, consumers, people, America. Interest. It's the biggest one. This is the rent that you pay to use their money. So if you borrow $10,000 at 10% interest, you aren't just paying back the $10,000. You're paying back the $10,000 plus the fee for the time that you had it. So we're talking about $11,000 equaling $10,000. You need 10, you're going to give the bank 11. Origination fees. These are those processing fees charged just for setting up the loan. It's like a cover charge at the club. Servicing rights. Yes, they charge you to actually service your loan, which again, servicing is simply just like filing paperwork. Banks often sell your loan to other companies but keep the servicing rights. This means they get a small fee every month just for processing your paperwork and sending you statements. Compound interest. In long-term loans like mortgages, you pay mostly the first few years solely interest and then very little principal, which is the actual loan balance. This ensures that the banks get their money up front. Now, we talked about bankruptcy briefly, so now I'm going to get into it in more detail. Bankruptcy is the legal process of admitting that you are financially defeated. It is your reset button of the financial matrix, but hitting that button comes with the heaviest price. So, bankruptcy the word comes from the Italian phrase bancarotta. The history is that in the Middle Ages, Italian money traders did business on benches in public marketplaces. If a trader couldn't pay his debts or was caught cheating, his creditors would literally smash his bench to show the public that he was out of business. So it was a public shaming that meant you no longer had a place at the table in the world of commerce. Today, we don't smash benches. We just destroy your credit score. So how does it work? So in 2026, bankruptcy is handled in federal court. It's not just saying it, it's actually a legal battle. There are two main paths for individuals. There's Chapter 7, which is liquidation. This is the most common for people with very little income. So here's the deal. You ask the court to wipe out most of your unsecured debt like credit cards or medical bills. Here's the catch. A trustee is appointed to look at everything you own. If you have luxury items, a second car, a boat, expensive jewelry, Jordans, whatever, they will sell them to pay back your creditors. Here's your timeline. Usually happens in 4 to 6 months. Chapter 13, payment plan or the reorganization. This is for people who have a steady job but are drowning. Here's the deal. You keep your stuff, your house and your car, but the court puts you on a 3 to 5 year payment plan. You pay every spare penny you have to the court and they distribute it to the banks. Here's the catch. If you miss one payment, the case can be dismissed and the creditors come back immediately. So, here's a feature, here's the short term, here's the long term, the stay. All debt collectors must stop calling, suing you immediately. This is the automatic stay. And that's for the short term in 1 to 2 years. For long term, the record of bankruptcy stays on your credit report for 10 years, Chapter 7, or 7 years for Chapter 13. Access to credit in the short term. You likely won't get a loan for anything. If you do, the interest rates will be predatory and it will be more than 25%. In the long term, you can eventually get a mortgage, usually 2 to 4 years after you're discharged from your bankruptcy. But you'll get a higher risk premium because you declare bankruptcy. Employment. So in the short term, some jobs like finance, government, security clearance may reject you for lack of financial responsibility because you declare bankruptcy. After those 10 years, the scar disappears and you can theoretically have a perfect 800 credit score again. However, the amount of work you're going to have to do is going to be climbing up from not just the bottom of the hill, but below, like underground, just to get to the ground and then climb back up again. In terms of housing in short term, renting a new apartment becomes very difficult. Many landlords will demand a 2 to 3 month deposit. So not only first, last, and security, they might ask for like 2 months. In addition, to that. So you might be paying first, last, second, fourth, and a security deposit, because they want to make sure, like, you already declared bankruptcy, you already said you ain't got no money. I want to make sure that, like, I ain't getting screwed out of this. And in the long term, you eventually become a normal borrower again, though the psychological weight often remains of the fact that, you screwed up at one point. So here are some invincible debts that you just can't get rid of through bankruptcy. So student loans, still extremely difficult to discharge and requires proving that you have this undue hardship that you just simply cannot pay, and you will never be able to pay in the future. Child support and alimony never get wiped away. Recent taxes, if you owe the IRS from the last 3 years, you still got to pay. And court fines or restitution. If you owe money because of a crime, bankruptcy will not absolve you from that. So, is bankruptcy a failure? Well, in America, we have this stigma to bankruptcy, but in the business world, it often is seen as a strategic tool. Many of the most successful CEOs have filed for Chapter 11, which is business bankruptcy, multiple times to shed debt and start over, which I won't even get into that scam because I'll let you find that fun one for your own. But for an individual, it's a tool for survival. If your debt gets so high that you can't afford food or rent, bankruptcy is a legal mechanism designed to prevent you from being a debt slave for the rest of your life. So, in summation, we got through it. I appreciate y'all. Credit is the key that opens the door. Loans are tools that you can use once you're inside. Interest is the price you pay for using those tools. Leasing is for those who want the tools without the responsibility. And bankruptcy is the emergency exit when the building is on fire. Ladies and gentlemen, those are financing options in case you did not know. I hope that has been very helpful for you, helps clears up some things that maybe you've heard or maybe you've thought about. Feel free to rewind this as many times as possible, mark certain chapters so you can know exactly where you want to listen. Very, very important. Make sure you're reading all the fine print and know what you're doing. I will leave you with a little life example, right? So back in the day, I was renting an apartment. I'm not gonna, throw any shade or throw any shots at anybody, but I had a landlord and found this apartment, thought it was really nice, moved in. It was like, I think it was like $800 a month. Little 1-bedroom. It was nice. Basically, no washer dryer. I paid for cable, I paid for electric. Everything else was covered, $800 a month. So after the first year I was there, rent went up about $50. Okay. All right, no big deal. And in the letter, it said that there was there's the cost of living increase, which is, annual. It's a regular thing. Rent goes up. Blah, 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 right? Like, all right, cool, whatever. So rent went from $800 to $850. All right, cool, manageable. Got my job, no big deal. Da da da. Do you know my rent went up $50 every year that I stayed there? Eventually got to a point I was paying $900 a month. And I was paying $950. I'm sorry. I was paying $950. I was like, wait a second. This is crazy. Like, you're telling me the cost of living keeps going up every year? I'm not saying it. And again, there's no changes that are happening. Like, the landlord is coming in, fixing things up, adding value to the property. If anything, because I'm using it, it should be depreciating value because, again, it's being used, right? And so what was funny to me was that I was there long enough that other people would move in, move out. And what I noticed is that the units, there were multiple units that were like mine. And then when I would get to meet the neighbors, just out of curiosity, right? No shade or anything. How much y'all paying rent? And they would tell me $800. I'm like, oh, that's crazy. So now I've been here X amount of years. So that's gonna happen to y'all too. So when next year comes, he gonna ask y'all to pay $50. Now here's the kicker. Here's where it really got really weird, right? So I ended up leaving, moved in with an ex-girlfriend. We broke up and I moved back into said apartment. Do you know when I moved back into said apartment? What was rent? $800. We started the cycle all over again. So what I came to realize is that the cost of living was just bullshit, right? But that's the racket that a lot of landlords run. Period. Is that, we got to keep up with inflation and, cost of living and, repairs, that's an extra fee we have to pay. But in reality, the longer I stayed there, the more I end up having to pay. Now, one mind of it is to say, you know what? That just helps push out people from overstaying their welcome. And not in a mean way, but just saying like, look, like, I want to help you during a specific moment in time, but not for the long term, which is valid and fine. Because if it gets to a certain point where I'm paying $1,000 and my neighbors are paying $800, that's a $200 difference in pay. And the argument could be made, well, if my apartment is valued at $1,000, you're actually losing money you're losing $200 for the other people that you have that are staying here. They're actually, shortchanging you because I'm paying $1,000 and they're only paying $800, and you could be getting an extra $200 every month. So I say all that to say there are different options. There are different things to consider depending on where you are in life, right? If you are getting your first job and you're just trying to get financially stable, and it's just you're building the foundation of your future generations, then I think initially you are going to want to look at renting or leasing an apartment. Now, if it's too expensive, get a roommate. Find something that your monthly payment is going to be manageable. And when I mean manageable, I mean something that makes sense for you financially. Don't overextend yourself to stay in some nice ass apartment because at the end of the day, you really just need a place to have a roof over your head and keep your shit. Occasionally cook some meals there, have a couple people over. Really, that's it. In a long-term grand scheme of things, like, don't overextend yourself on that aspect because eventually you're going to want to, upgrade and move on into bigger and better things in your life, whether that's getting married, having kids, all that kind of stuff. You're likely not going to want to do that in that apartment. That might be a great transition space and get you to get your feet wet and save some money up. So put yourself in a position where you can actually save the money up. Don't put yourself in a situation where you're going to overextend yourself and now you didn't live there for 5 years and you're still financially struggling. That shouldn't be the case. You should be in a position where you've saved up a little bit of money and now you can start putting money down towards a down payment for a house or something bigger and better. All right. Appreciate y'all. If you have any questions, hit me up in the chat. Love to hear from you guys. Like, subscribe, do all the things to get me going in the algorithm. But yeah, holla y'all. One. Thanks for listening to another episode on Life's Hidden Curriculum Podcast. Please don't forget to like and subscribe on YouTube as we're on the road to 10,000 subscribers. If you like this content and want to support, head over to the website, lifeshiddencurriculum.com, and click donate. Also, I'm always looking for guests to share their stories, especially if it can help the next generation. Hit me up using the contact link. Thanks again, and stay tuned for more.